Welcome to The Explainer. Okay, let's jump right in. We're looking at a pretty fascinating idea today. What if you could take the money you lose from things like delays and compliance headaches and actually turn it into a real, provable asset on your books? We're going to break down a system designed to do exactly that, specifically for trustees and enterprises. Right, so think about this. Every single business deals with friction. You've got opportunity costs, regulatory burdens, unexpected delays. These things cost real money. But where does that value go? Usually it just vanishes into thin air, right? It's just written off as the cost of doing business. Well, today we're exploring a system that's built to capture those losses and turn them into tangible, auditable records of value. So here's the absolute core of the problem we're talking about. If you're in any kind of fiduciary role or you're running a big enterprise, you know that certain economic losses are very, very real. The issue is they're incredibly difficult to pin down, almost impossible to prove, and, well, good luck actually getting compensated for them. I mean, just think about the real-world impact of a major project delay, or the mountain of paperwork and man-hours that go into compliance. These aren't just minor annoyances. They are real costs that drain resources from a company. But historically, how have we treated them? They've just been stories, right? A narrative. You can't really use them to justify compensation in a defensible way. You know, this single line right here, it just perfectly captures the entire challenge. The whole goal of what we're looking at is to move beyond that storytelling and get into the world of structured, verifiable facts. So the big question is, how do you do that? How do you make these invisible costs, well, visible and tangible? How do you turn a story into something an auditor or an accountant can actually work with? Well, the key, it turns out, is to stop treating these events as narratives and start treating them as data points. And you can see that whole transformation right here on this slide. On the left, you got the old way, kind of messy, informal notes about some loss. But on the right, that exact same economic impact becomes a standardized, evidence-backed record. This is a huge shift from an informal story to a formal piece of data that a system can actually understand and, more importantly, act upon. And this is the core tool that makes it all happen, the Economic Value Record, or EVR for short. The easiest way to think of it is as a standardized digital container, kind of like a secure envelope, that's designed specifically to hold all the critical details of an economic impact, whether that's a gain or, in this case, a loss. And this is where you really see the power of the EVR, whether it's the cost of that delay, the massive burden of compliance, or a missed opportunity. All these things that were previously just absorbed as operational friction, the EVR gives fiduciaries a formal, structured way to document and measure them. It literally turns, oops, we lost time, into a quantifiable, provable record. Okay, but wait a minute. Just because you measure something doesn't mean you can magically turn it into an asset you can stick on your balance sheet. That would be chaos. This is where a really critical governance layer comes into play to make sure everything is legitimate. And this is absolutely key. The system has built-in safeguards to make sure you can't just invent fake assets out of thin air. You know, measuring the impact is just the first step. It's definitely not the last. This whole workflow is called the allowance gate, and it is crucial for financial integrity. It guarantees that a measured impact only becomes a formal, bookable receivable after it's been submitted, vetted, and, this is the most important part, explicitly approved by a human authority, like a trustee. That human approval is the key step that turns it into a legitimate financial record. It's basically like creating and approving an official invoice for the loss that was experienced. And this adds yet another critical layer of human control. The system provides all the data, all the evidence, the full audit trail, but the final decision, whether you want to formally recognize a value, maybe defer it, or even just ignore it, that is always a user-directed choice. And of course, every single one of those decisions is logged, which creates total accountability. So now that we have this trustworthy, human-verified asset, what can we actually do with it? Well, this is where things get really, really powerful. Because now you can start to automate complex treasury functions with a level of confidence that just wasn't possible before. And here is where it all comes together. Because these brand new receivables are backed by a rock-solid, auditable trail of evidence, they can be trusted. And because they can be trusted, they can be used as reliable triggers for automated financial operations, like, for example, sweep accounts. So, in the world of a trust, sweep logic is an incredibly powerful automation tool. Think of it like setting up automatic bill pay for your personal bank account, but, for a multi-million-dollar trust.
It's a pre-programmed set of instructions that automatically manages the trust's daily cash flow based on its specific priorities, without needing a person to jump in and manually approve every single transfer.
So, for example, a trust's treasury can be set up with a clear waterfall, just like this. At the end of each day, any surplus funds are automatically swept. First, they go to cover immediate operating needs. Then, the system funds what's called a CCL reserve, which is basically a required fund to cover expected credit losses. And finally, any money that's left over goes to a premium reserve. And this all happens automatically, based on those clear, auditable triggers we talked about.
All right, let's zoom out for a second and look at the really big picture here. Because what we're talking about isn't just a clever accounting feature. It's a fundamental shift in how trust and verification are handled in the first place.
This is probably the most important idea to grasp. When it says it tokenizes proof, it means it's not trying to create a new digital currency or anything like that. Instead, it's creating a unique, unchangeable digital certificate, a token, that represents the proof of an event. This unbreakable, legally defensible record of proof is what justifies any and all subsequent movement of value.
So what we're really talking about is a whole new system of record for legal and fiduciary work. It's a system where payments and compensation are no longer based on stories or just someone's discretionary decision, but are instead justified by a clear, permanent, and provable chain of evidence.
So, what should you really take away from all this? It's that this proof-first approach leads to three really powerful outcomes. One, it creates a basis for defensible compensation for trustees. Two, it builds regulator-safe audit trails for every single action. And three, it allows for automated compliant operations, just like those sweep accounts we just discussed. Ultimately, this fundamental shift, from relying on a narrative to relying on a provable receipt, doesn't just solve old problems like ambiguity and disputes. It actually opens up entirely new possibilities for how trust, value, and compliance are managed in our increasingly digital world. Which leads to a pretty interesting question. When every single action has a receipt, what does become possible?